You started out by talking about Paul Volcker, who obviously cast a long shadow. I wonder if, in hindsight, that shadow was too long, and if in the decades since his tenure, and in particular last year, if the Fed was too quick to raise interest rates to attack an inflation boogeyman that didn't materialize.
This wouldn't be my response will not be about Paul Volcker, but although you started with Paul Volcker. So if you look back at 2018, I'll just take you back to the beginning of 2018. We had an economy growing at 3%. We had inflation at 2%, and we had $1.5 trillion worth of stimulus arriving, and the federal funds rate was 1.4%. So it wasn't that. So we moved policy up during the course of the year. We never got policy even at the level of what we thought the neutral rate was at the time. So there was no sense of it being restrictive. We took steps to make it less accommodative, and that seemed to be the right thing. It still seems to me to be the right thing in hindsight. The idea that we were trying to, slow the economy down, we were really just trying to get near neutral. And even with the last rate increase a year ago, we were still meaningfully below the median estimate on the committee of what the neutral rate was. So policy was always accommodative during the course of that year. I think what's happened is obviously the facts on the ground have changed. You saw the global economic slowdown begin in the middle of last year, gather force, and then continue to go on this year. So you've seen a continual weakening. Just look at the IMF's forecast of growth from the spring of 2018 and compare them to now. You've had quite a significant. That does affect us. I think also the trade situation was just beginning in the middle of 18, and I think it has had. I think there'll be very, very wide range of estimates of the effect, but I think it's had a meaningful effect on output just through the uncertainty channel and to a lesser extent through the tariff effects. And again, that's not to make a judgment. It's not up to us to make a judgment about that. So that would be my story.
Okay, Donna. Chair Powell, Donna Borak with CNN. To follow up on Edward's trade question, could you talk about what you would imagine the economic effect would be if negotiations with China were to fall apart, and how the Fed might be able to support the economy in that event?
I wouldn't want to speculate on a hypothetical. I would say we'll just have to see. We look at a range of factors, and we, as I've said before, we try to look through the volatility in trade news and trade negotiations. We try not to react. We can't react. Monetary policy is not the right tool to react in the very short term to volatility and things that can change back and forth, as this has happened, as is probably typical of a large, complex negotiation. So in terms of, I don't want to get into hypothetical outcomes, though, if that's all right.
I'm just wondering, you met with the president last month. Did you have any advice for him when it came to this? And did you express some concerns about potential volatility and the impact of the economy given all this?
I'm going to stick with my predecessor's longtime practice of not discussing private meetings with elected officials or other officials, really. But thank you.
Virginie.
Thank you. Virginie Montet with Agency France Press. Yesterday, Democratic leaders in the House have launched an impeachment process against the president. Have you mentioned these developments within the committee today as potentially presenting some risk for the confidence in the economy?
No, we have not. We don't consider things like that.